Okay, so welcome to my introductory video on internal controls in the purchases and payables cycle. In this seminar, I'm going to have three learning objectives. So three things that you need to be able to do by the time we finish this seminar. Firstly, you should be able to describe the stages in an auditor's assessment of internal controls. I'll run through those stages in this video. Secondly, you should be able to describe and explain the internal control procedures that should exist in a company's purchases and payables cycle. So what I'm going to do is to run through using flowcharts and narratives what the controls should look like in a company that has perfect internal controls. And then thirdly, you should be able to identify and explain the control weaknesses that exist in the purchases and payables cycle of any given company. So in other words, having shown you in the class what the controls should look like for a company that has all of the necessary controls in place, you should be able to identify, if I present to you a case where the company doesn't have those controls, you should be able to identify which controls are missing. Okay, so in other words, you should be able to identify where the control weaknesses are by comparing to the ideal company that has all the controls in place. Okay, so those are the learning objectives for this seminar. Reading, as always, you should look through the class questions in this seminar outline. There's this video that you're viewing at the moment as well. Have a look at chapters 12 and 18 in the Aarons, Elder and Beasley textbook. And also there's some recommended reading from Auditing Standard 2201, which is about auditing of internal controls. There are three questions for this seminar. The first question is relating to the documents that you would expect to find within the purchases and payables cycle. We're going to run through those documents as we go through the flow chart of a company that has an ideal internal control system. So you need to understand what these documents represent. Okay, so that's our first question. Our second question is to consider the controls that should exist within the different departments that are involved in purchases and payables. So in particular for question 2, we'll think about the purchasing department. That's the department that arranges for the purchase of the item that is being acquired. Then there's the accounting department and the cashier department. So we're going to think about all the controls that should exist and what's the rationale, what's the purpose of each control procedure. Then question 3, I'm going to give you an example of a small company where all purchases and sales are handled by just one person. So this person is responsible for making payments to suppliers, for receiving and depositing payments from customers, and recording the purchase and sales transactions in the accounts. And part A asks, if an additional person is hired, how would you recommend that those duties be divided between the 2 members of staff? And part B, if an additional person is not hired, how would you respond as the auditor? Okay, so those are the 3 questions we'll cover in class. And then in addition, we have some multiple choice questions as shown here. Okay, so let me run through now the stages in the auditor's assessment of internal controls. Then after we've done that, then during the class, I'll run through how you actually assess internal controls within the purchases and payables cycle. So when doing any internal control audit, the auditor follows the following steps. The first step is to obtain an understanding of the company's internal control procedures, right? So in other words, you need to understand what procedures the company believes that it has in place. Secondly, based on that preliminary understanding, you form an evaluation of control risk. So if the client tells you, yes, we have all these controls in place, then your preliminary evaluation of control risk would be low. If the client tells you, no, there's many of these controls we don't have, then your preliminary evaluation of control risk will be high. Now, you can't rely just on what the client tells you, so that's why we go to step 3, which is the test of controls. So after you form your preliminary evaluation, you have to check that that evaluation is accurate by actually testing the effectiveness of the company's control procedures. Then in step 4, you provide an updated evaluation of control risk, which is based upon your results of the tests of control. So it may be that, for example, your preliminary evaluation of control risk is low. In other words, you think that the controls, the company has lots of controls in place, but then you find from your test those controls are not working. So then your evaluation of control risk would have to be increased in step 4. And then in step 5, if the client is subject to SOX 404B, in other words, if this is an accelerated filer, then you need to issue an internal control opinion. So what I'm going to do now is to run through each of those 5 steps. So the first step is to obtain a preliminary understanding of the client's internal control procedures. And you can do this in various ways. So one way is using flowcharts and narratives. So what's a flowchart? Well, a flowchart is a diagram that represents a workflow or process. And in this diagram, it will show the steps as various kinds of boxes of different shapes. And I'll come on to that a little bit later. And these boxes are all connected to each other with arrows, which indicate that documents are flowing through the accounting system. Okay, so using flowcharts is one way in which auditors obtain an understanding. So these flowcharts and narratives will describe how the documents flow through the system, and it will also show the separation of duties within the internal control system. And we'll see an example of this later in the class where I show you the internal control system within purchases and payables for a company that has a very strong internal control system. Okay, so that's the first way to obtain an understanding. A second way is to perform what's known as a transaction walkthrough. So what's a transaction walkthrough? Well, it's where the auditor walks through a transaction from its very beginning right through to the end. So the beginning of the transaction cycle usually starts with some kind of source document. So in the case of purchases, for example, it would be the purchase requisition that is filed with the purchasing office where somebody is making a request to purchase something on behalf of the company. Okay, so that would be the beginning step. And then you walk through all of the intermediate steps until you reach the end, which is where the payment to the vendor is actually recorded in the accounts. So in all the intermediate steps, you've got the purchasing office sending out a purchase order. You have the goods being received and counted and being accounted for. And then you have the vendor sending in the invoice and that invoice being checked and then paid, and then that payment being recorded in the accounts. So that's the entire cycle. And basically the transaction walkthrough is following a single transaction through that system. Now notice that a transaction walkthrough is not the same thing as a test of control, because with the transaction walkthrough, you're only looking at one transaction. Okay, so whereas with tests of control, you're usually looking at a sample of transactions to assess how well the controls are working. So when you do the transaction walkthrough, at each stage of the cycle, you have to consider whether the transaction has been properly authorized, whether it's been properly executed, and whether it's been properly recorded. Okay, and I'll talk more about that when we go through the company's purchase and payable cycle. So those are 2 ways in which you obtain an understanding. A third way is using internal control questionnaires. Okay, so what is an internal control questionnaire? Well, it's a list of questions which an auditor provides to the company and its employees before the auditor tests internal controls. Okay, so for example, here's a list of questions that the auditor might ask relating to payroll processing. So for example, are all employees paid by check or by direct deposit? Is a special payroll bank account used? A payroll check signed by persons who do not prepare checks or keep cash funds or accounting records, etc. Okay, so it's basically a list of questions where you're asking, does the client have the control in place? And the answer is here, it's either yes or no. So this is a form of client inquiry. right? You're actually asking the client some questions, and because it's client inquiry, that is not very strong evidence. So you need corroborating evidence. In other words, you need tests of these controls in order for you to make the conclusion that control risk is low. So what are some of the advantages and disadvantages of internal control questionnaires? Well, one of the advantages is that a questionnaire can be designed to cover most aspects of internal control. So if you look back to this picture here, you can basically list all of the questions that you want to ask. Okay, so it can be pretty comprehensive. Secondly, you may be able to apply the same questionnaire from one client to the next. So once you have drafted an internal control questionnaire, you can use it on multiple audits. In fact, most of the time when you go and work for an audit firm, there will already be questionnaires that are set up. So you don't actually have to come up with a new questionnaire. You would use one that has already been designed. And then thirdly, when it's complete, questions can be quickly reviewed for internal control weaknesses. So in other words, you can look at the yes, no column here to see, whether the client has the controls in place or not. So those are the advantages. What are the disadvantages? Well, one disadvantage is that questions focus on individual parts of internal control rather than the system as a whole. So notice that each of those questions, they're very specific to a particular area, but it doesn't give you a holistic or general overview of how the system operates as a whole. So that's one disadvantage. Second disadvantage is something we've already mentioned, that questionnaires are simply inquiries of client, and therefore they're not very reliable as evidence, right? It could be that the client says, yeah, we have all these controls in place, but in fact the controls are not there, or they're not working very well. And then finally, the questionnaires may be too standardized for some clients. So it may be that the client that you're auditing is just too different for you to use any of the existing internal control questionnaires. So you may need to modify the list of questions to suit the client that you're auditing. Okay, now we move on to the second stage. So after you have obtained your understanding of the control system, then you form a preliminary evaluation of control risk. And the reason for doing this is that the auditor wants to know whether the auditor can rely on the company's internal controls, right? So performing tests of internal controls is helpful for reducing the cost of the audit if the controls are strong, because that means that the auditor can reduce the amount of substantive testing that needs to be performed. If the auditor doesn't test any internal controls, then the auditor is going to have to rely only on substantive testing, which is relatively costly. Okay, so auditors usually want to rely on internal controls wherever possible because substantive testing is so costly. So if you can rely on the client's internal controls, you can reduce the amount of evidence collection from substantive testing. So if your preliminary assessment of control risk is low, you may plan to reduce the amount of substantive testing that you're going to perform. But then you have to actually test the controls to make sure that your preliminary assessment of control risk is correct. So in other words, if you think the control risk is low because the client has very good controls, then you have to actually test whether those controls are operating effectively. On the other hand, if your preliminary assessment of control risk is very high, then you may decide not to bother testing internal controls at all. Right, if you remember back to the audit overview class, I laid out the 5 steps in an audit, and the third step was testing internal controls. And I said that sometimes an auditor may decide not to test the internal controls because the auditor's assessment of control risk is very high. For example, the client says, well, we don't have these controls in place. So if that's the case, then you don't test the controls. Instead, you rely only on extensive substantive testing. And that, of course, the downside from this is it's going to increase the cost of the audit. And so the client is going to have to pay a higher fee. The third step then, if you decide that your preliminary evaluation of control risk is not very high, and so those controls are going to form the basis of reliance, then you're going to actually test the controls. How is this done? Well, typically this is done through observation and documentation. So with observation, you're seeing the control procedure actually being performed. So I remember, for example, one of the first jobs I had as an auditor was to accompany the cashier to the bank at the end of the day to observe the cash actually being banked, right? That is a control procedure that cash receipts should be banked every day. So you can do this through observation, and another way to do it is through documentation, where you can look for evidence that the control is actually being performed. So what should you consider when you're testing controls? Well, firstly, are the control procedures actually being performed? I mean, it may be, for example, that the company says they have these controls, but you go along and you find that the control is not there. For example, the company may say, well, on the year-end date, December the 31st, we're going to have an inventory count, and then you go and turn up and there's nobody else there. There are no employees there to do the inventory count. Right? So is the control actually being performed? Secondly, how well is it being performed? So for controls that are performed on all transactions or should be performed on all transactions, you may find that there are some transactions where it's not being performed. For example, authorization of purchases. It may be that 80% of purchases are being properly authorized by an independent person, but 20% are not. And then the third thing is who performed the control, right? And so this is to do with the segregation of duties. If you have a purchase that's being subject to independent authorization, then it wouldn't be proper for the purchase to be authorized by the person who actually initiates the purchase requisition. Okay, so we need to ensure adequate segregation of duties, right? So you need to check who is actually performing the control procedure. So some risk factors to consider when you're testing the internal controls. Firstly, changes in personnel. Okay, so this is important because the quality of the personnel who are performing the controls could change during the fiscal year. Right? It may be, for example, that in the first part of the fiscal year, the person doing the control is not very effective, they may be a bit lazy or careless, and that person may end up leaving the company during the year, and then they're replaced by somebody who's much better. So if in that situation you only test the controls towards the latter part of the year, then you're going to ignore the fact that control risk has actually changed, right? It was high in the first part of the year, and then it fell towards the end of the year. Okay, so consider changes in personnel. And then secondly, consider whether there are any seasonal fluctuations in the volume of transactions. So certain types of company are going to demonstrate a high level of seasonality. So for example, imagine an ice cream company, right? It's not going to sell as much ice cream in the winter as it is in the summer. So you'd expect the volume of transactions to vary during the fiscal year. Now, why is that related to tests of controls? Well, the reason is that when the volume of transactions is very high, the company may not have a sufficient number of employees to properly carry out all of the internal controls. Right? So the company may be cutting corners during a period where it's very busy, just because it doesn't have enough time and manpower or person power to actually carry out the internal controls. Okay, so these are a couple of risk factors you have to consider in terms of the operation of controls throughout the fiscal year. The fourth step is to perform an updated evaluation of control risk. So this updated evaluation is based upon the results of your internal control tests. So if your preliminary evaluation of control risk was, say, the control risk was maybe 5%, and you find that internal controls are weaker than you expected, then you have to increase your evaluation of control risk, right? So it may be that you raise your assessment of control risk from, say, 5% to 20%. Now, if that's the case, then you need to do more substantive testing to achieve your desired or acceptable level of audit risk. Now, even if you find that the controls are very strong, so your preliminary evaluation of control risk was low, and you test the controls and you find that it all seemed to be working well, you still have to do some substantive testing, right? You can't just say, okay, we'll rely entirely on the company's internal controls. And the reason for that is because there are inherent limitations to internal control systems, okay? And I'll talk more about these inherent limitations later in the PowerPoint slides. The auditor should investigate any underlying reasons for a company's failure to comply with its own internal control procedures. So if you find internal control weaknesses, you need to find out why, right? Is this human error? Is it because there is insufficient oversight of employees by higher level management? Is it that the company's employees are overworked so they don't have enough time to carry out the control procedures? You need to find out the reasons why, and that will be important when you report back to the management and to the audit committee about what you found. So that brings me to the last bullet point here, that if you find significant internal control deficiencies, then you have to communicate those with management and to the audit committee. Or if it's a private company that you're auditing and it doesn't have an audit committee, then you need to report to the board of directors. Okay. So step 4 was updating your evaluation of control risk based upon your tests of control. Step 5 is a step that you only perform if the company you're auditing is a public company which is large enough to qualify as an accelerated filer. So in that situation, you have to issue an internal control opinion on the client's internal controls. So SOX 404B requires the auditor of an accelerated filer to report on the effectiveness of internal controls over financial reporting. Notice you don't have to report about any other types of internal controls. You don't have to report about, for example, safety within the company's factory or anything like that. Strictly speaking, it's just talking about controls over financial reporting. What's an accelerated filer? Well, it's a public company that has at least 75 million as a public float. Okay, so what's a public float? Well, a public float is the company's market value less any shares that are held by company insiders. Okay, so for example, suppose the company's market cap is 10 million, and suppose 10 million of those 10 million shares, 1 million is held by the company's management. So management own 10% of the company, in other words, then the public float is going to be 9 million, right? So companies with a float greater than 75 million are classified as an accelerated filer. Now, assuming there are no restrictions on the scope of the audit, and normally that's the case, then the auditor issues one of two types of opinions. The auditor can issue an unqualified opinion if there are no identified material weaknesses, or if there are one or more material weaknesses, then the auditor issues what's called an adverse opinion. Okay, so that's where I'm going to stop this video. This is the point at which I'll start in the class. And so in the class, we're going to run through the purchases and payables cycle of a company that has very good internal controls. So we'll work through a transaction from the very beginning to the end, and we'll talk about how the documents should flow between the different departments, the segregation of duties that should be in place, and the controls that you'd expect to find within each department. Okay, thank you for watching.